So, welcome you all after the 5 minute break for the banking sector and stock analysis. In fact, from the first webinar on drop and pick, from very next day, the demand was of banking sector analysis, and it was pretty difficult to analyze the stocks of a banking sector. Now, I think majority of the work on banking sector analysis is done by Dr. Nishit Patel. Hence, I have written both of us name and I am just made the presenter of the data. Why it is important? If we see the Fin Nifty percentage in Nifty 50 in 2004, it was around 12.8%. And over the next 2 decades, it grew up to almost one third, that is 32.5%. So obviously, the financial companies and banking sector companies give a prominent part in Nifty 50 index as well. And if we just dissect the whole sector, the banking still plays a major role of around 64%, then housing finance around 19%, then non-banking finance companies, insurance companies, power financial services, and other financial services have their little part to make the whole index. But NBFCs are difficult because it's difficult to find their evaluation parameters. Insurance have their own separate regulator IRDAI, and they are also prone to lots of government policy decisions. AMC business, only few companies have been listed, and I think we are not going to touch them because you require really good expertise, and we can definitely keep them for the professional fund managers or other professional fellows. So we are going to restrict and focus our analysis only on banking sector. Why banks? Because we all have bank accounts. We know the business of banks. We use in our day-to-day life. We deposit money in banks. Most of us have taken the loans. We are very, uh, you know, using its various products. We're familiar how they function. They take deposits, they give loans, and its business is very easy to understood. But they are very tightly regulated. And the biggest problem why we took so much time that it's difficult to find its relevant fundamental ratios at one place. So that's why we need to dig it more. Now, if we classify the banking structure in India, the RBI is the main regulator, and we have mainly three types: commercial banks, specialized banks, and cooperative banks. And the commercial banks, we have private banks, public banks, small finance banks, payments bank, rural banks, and foreign banks. Specialized banks are meant for special purposes. So this is a small industrial development banks to enhance small industries. NABARD is for agriculture and rural development, and EXIMs are the export import banks. And cooperative banks, we all know, cooperative banks are under the state government and then they have to report to RBI. We are going to restrict our discussion only on the commercial banks today. Now, for banking sectors, we all know for whole drop and pick, we have said this is for non-banking stock, non-finance stocks, because banking require a different evaluation parameters. And if you can see, the structure is still remains same. The pillars have been changed. So instead of solvency, we have revenue. Instead of profitability, we have capital adequacy. We have asset quality, and we have a deposits and loan. And these are the parameters on which we need to evaluate the banking stocks. If we see the revenue, how bank earn, they earn from corporate loans and retail loans. They also have a treasury income. So because they are going to invest in certain bonds, they are going to invest in certain derivatives, they are going to invest in certain debentures, and they are getting the interest income out of that investment. And there are other incomes from their allied businesses like insurance, investment banking. Say for ICICI Bank, they have ICICI Securities and other insurance subsidiaries from which they will earn. All retained loans have to keep a provision of around 10% for the priority sector, say for rural, for agriculture, for MSME. And for treasury, they have to keep around 7 to 8% as a statutory liquidity ratio, which can be redeemed at any point of time when the banks are under stress. So the income from corporate and retail loans is known as interest income, which is the basic crux for any banking stock evaluation. And from treasury and other are the non-interest income. So the first ratio or first parameter which we are going to use for our banking sector analysis is the net interest income and net interest margin. Net interest income is easy, as the name suggests. It is the difference between interest earned by bank on their loans minus interest paid on their deposits, and it should be positive. What is net interest margin? The net interest income divided by the average interest earning assets. And mind you, there is not a single parameter or a single value for this, because this used to change every quarterly, every annually. So if you Google it and see what is the net interest margin for banks for year 2024, that is 3.6%. That means any bank who has an NIM more than 3.6 in March is considered to be a good bank. Then comes the capital adequacy. We all know the 2008 subprime issues happened in USA, and then it spread, and the bear cycles and all the economies have suffered across the world. So from then they have devised a Basel III norms, and when they said we need to keep this much of the capital adequacy for every bank. For rest of the world, the adequacy ratio is 8%, but as India is a developing country, our RBI is kept little higher, that is 9%. So it should be more than 9%. And what will come into that? They have divided it into two parts, tier 1 and tier 2. Tier 1 is a common equity uh, pool where you have a various banks have invested in various equities, statutory reserves, and surplus, which has to be minimum 5.5%. Alternative tier 1 is debentures and preferential shares, is around 1.5%. Tier 2 also like debentures and preferential shares only. But the difference between 81 and tier 2 is when there is a stress, bank first liquidate 81 portion of 1.5%, and then they will liquidate that tier 2 2%. And then you can develop this ratio by this formula of tier 1 plus tier 2 followed by risk weighted assets. What is risk weighted assets? Bank's assets are the loans. So if you have a home loan with a mortgage, then it is considered to be a less risky compared to a personal loan where you may not take any mortgage and you are giving on a higher interest. So they will have a formula which consider each and every loan, and then they will come with the unique value, and then this CAR has been calculated automatically. In addition to this, RBI is mandatory to keep a buffer of around 2.5% for all the banks. So if we see 9 plus 2, that means 11.5% has to be the minimum capital adequacy ratio. And we know that there are three DSIBs, that is domestic systematically important banks, SBI, ICICI and HDFC, because if they fail, then the whole economy will collapse. So they have to keep additional tier 1, SBI zero point 0.6 and ICICI and HDFC zero point 0.2. So if we say 11.5 plus zero point 0.6 of SBI, so it is around 12.1. So for year analysis of any banks, we are going to keep minimum CAR more than 12%. Then it is a good bank, at least fundamentally strong. Asset quality, we know that banks give loan to different assets, and if we see this example, obviously it is evident that bank 1 is well diversified because they have given their loan across various segments, retail segments like housing loans, car loans, farm loans and a business loan, while bank 2 has given only corporate loans, business loans. So the diversification is not good. irrespective of your retail or corporate loan, every loan book have bad loans, which is known as a non-performing assets. And I think 99% of us, including me, when there has been a talk of a banking sector, we are knowing only one ratio, that is NPA, that is non-performing asset. There are two ratios, gross and net. What is gross NPA is? It is the total gross NPS divided by the total asset. And high ratio indicates that the bank has a large number of loans that are not being repaid. While the NPA is an absolute value when they took the total gross NPA minus the provisions. But here important thing is that net NPA is a measure of actual losses that bank has incurred because they have already made the provisions. Probably they have thought that these loans are not going to come and that they have booked. So that's why it is an importance of net NPA. Every bank will keep certain provisions. So if certain loans are not being made, they can use that money, which is known as a provision coverage ratio (PCR). And if we see this is an example of SBI, the PCR of SBI is around 76%. That means they have made a provision of almost 77% for the fourth quarter of financial year 23. So if their gross NPA is defaulted, at least they have a provision for almost repayment, for so not repayment, but they can adjust the losses up to the extent of 77%. Ideally, we should have more than 70% of PCR, which is considered to be healthy. And you can see the ratios in the investor presentation. It is very easy to see. This is an ICICI Bank's ratio. If you see quarter on quarter, 2.81, 2.30, and 2.16, it is reducing. Even the net NP also has been reducing, and because the gross NP has been reducing, they are also reducing the net provision coverage ratio. There comes the deposits and loan. Another thing we always remember, second thing about banking sector is CASA. So bank can have four type of deposits broadly: current account, savings account, fixed deposits, and recurring deposits. One and two collectively known as a CASA deposits, current accounts, savings accounts, deposits. And when you divide the CASA amount divided by the total deposit, this gives you the CASA ratio. Now, how banks can borrow, because they also need a money. So either they can utilize the fund remain in their CASA accounts, which is only 3 to 4%. Current account they are giving 0% interest. Savings account now only 3.54% majority of banks, and then they can give loans of around 8%, 9%. So they will give a good margin, or they can borrow from RBI as per the current repo rate, which is around 6.5%, or they can issue bonds and debentures to raise the capital, on which they have to give 7 or 8% interest. So we can see that CASA is the cheapest source of funds for bank to borrow and lend as a loans. So everyone is behind CASA. So if you see in their annual report, they can give you the CASA ratio. This is the SBI's annual report, investor presentation, and they can give you the bifurcation also. That the CASA for March 23 is 43.80, March 24 is 41.11. There is no a single parameter or single value here, but again you have to compare across various banks. But 40 to 50% considered to be a good CASA ratio. And here again, if you see current account is less, savings account is more. Again, more current accounts are more preferable. Loans, as I said, the better diversified retail and better diversified corporate loans are a good parameter. And this is again a snapshot from IDFC First Bank's investor presentation. And if you can see, the loan books have diversified across too many things: two-wheeler loans, car loans, financing, gold loans, micro and MSME loans, and the larger are the home loans, 11%. And even the home loan, loan against property, business and banking, they have mortgage. So I think the stability of the loan is very good, and every bank will give credit to each and every loan of them. So we have to look for whether it's credit A, because that is considered to be very stable, and you can also evaluate on that parameter as well. These are the main evaluation ratios for the banking parameters. Unlike drop and peak, we don't have too much in the fundamental ratios, and here we have very few ratios like return or efficiency ratios as ROA and ROE, growth, sales and profit growth, and valuation we are going to use as Dr. Nishit has said that price to book. ROA is the return on assets, and we know what is bank's assets. They are the loans they are giving to the customers. So net income divided by average total asset is ROA. Cash flow analysis is very difficult in banking sector to do. So ROA indicates per rupee profit bank earns from its loans, and we again need to compare it with the peers. And ROA more than 1% is represent a substantial revenue and profit. Unlike we are used to 8%, 10%, 15%, 20%. Here ROA usually in tune of 1%, 1.52%. Still they are very good. ROE, we know now that it's a net income divided by average total equity. It's a profitability ratio, so it will measure the profitability of a bank and how efficiently company using it equity financing into profit. And again, if it is sustainable ROEs, it can tell you that the growth of bank is sustainable, and dividend growth rates also can be predicted on base of ROE. And again, there is not a single value for this thing. So RBI releases the data every year, and this is, if you can see the return on asset is around 1.2% average, and ROE is around 12%. But more than 8% ROE is considered to be good for bank. Price to book ratio, Dr. Nishit has mentioned briefly, it is a valuable ratio for banking sector analysis. It is the price per share divided by book value per share, and you will derive this book value from total assets minus intangible assets minus liability divided by outstanding shares, and you will get it ready-made everywhere. Again, being a valuation ratio is going to tell you whether it's a undervalued or overvalued stock. It shows value given by the market for each rupee of company's net worth, and we always going to look for GARP stock, that is reasonably priced, and it is useful for the sectors with a positive book value and negative earnings, and it just tells you whether the company's market price is reasonable to its balance sheet or not. And again, same what Dr. Nishit has said, we are going to use it in the similar manner: value, GARP, GAP, and BAP. Additional to this, RBI publishes various reports semi-annually and annually. So those who are interested can go into this, where you can find the report on trend and progresses of banking in India and various financial stability reports. This is the one report where you can see the net interest margin, and they have subdivided for everything: public sector banks, private sector banks, foreign banks, microfinance, payments, and all. If you see all, it is around 3.2%. So for public sector it is 2.4, for private sector is 3.6. So you might have to just see at the end of a financial year. Even if you Google it, they will straight away let you know what is the existing NIM value. And this complex, complicated banking sector we have tried to fit into another set of criteria, again named by Nishit, known as press and pick, just to have a sync with drop and pick. So we screen and we do a trend analysis. Now there is lots of criteria are not available in screener. That is the biggest problem. So here we just have a screener which can tells you the good companies, and then you have to individually assess them on stockage. So what is press? Press is promoter pledge. R for ROA and ROE. This both R is different from drop. We have drop ROCE. E for earning growth and S for sales growth. N stands for the newer set of criteria. That's why instead of A and E we have kept N, that is net interest margin, gross NPA, and net NPA. And PIC is almost similar to the PIC criteria. P for profit loss and balance sheet, I for investor. Again, C is a different set of criteria, that is CASA, cost to liability, and capital adequacy ratio. K know your bank, and valuation we are just going to consider only price to book. But again, these are a qualitative measures, so that again we need to check it. So what are the values for press? Place, P for pledge, again less than 5%. ROA should be more than 1%, as I said. ROE more than 8%. Earning growth, TTM 3 year and 5 year CAGR more than 12.5, and sales growth more than 10%. So if we have a screener, if you run that, then they will just give you the companies which pass all these press criteria. Same way, N we need to check every year on Google. So NIM more than 3.6 if we are analyzing any company in August 2024. Gross NPA should be less than 3% and net NPA should be less than 1%. And this we have to analyze from stockage. And pick profit loss and balance sheet. These are the parameters which we are going to check. It is not that much on non-banking stocks. Here we have made your life little easy. So in profit loss, we are just going to see only two things: what is the interest earned and what are the provision company has kept for in case of any default. Balance sheet only three parameters: equity, deposits, and advances. Investors will remain same. Whether the promoter FII plus DA in public is increasing or decreasing, we are giving them the figure and flag accordingly. C. CASA, cost to liability and capital adequacy ratio. These two you will get from stockage, and as I mentioned that it is pretty difficult to getting all things at one place. CAR is not available in screener, not available in stockage, so we have to go to a phenology by ticker. Even you can just Google it and you will get it for the particular bank. And we can just give flag and feather accordingly. CASA of fast year, whether it last 5 years, if it is increasing, give feather, decreasing flag. Cost to liability ratio, same last 5 years, whether it is a decreasing, then it is a feather, increasing is a flag. And capital adequacy ratio, as I mentioned, because we are taking a cutoff range of 12, more than 12 is a feather, less than 12 is a flag. And we just know the company from various resources and value analysis. And now we just see the practical demonstration of press and pick. So here, this is the press screen, pledge, ROA, ROE, earning growth, and sales growth. Now let us see the ICICI Bank, which is the flavor. Now this is basically the drop screen, but we can get almost everything except ROA from this. So pledge, now we knew it's here, it's 0%. So that is tick. ROA we will not get it. ROE, earning growth and sales growth, all these three we will straight away get it from profit and loss here. Sales growth, profit growth, and ROE. So it is little easy here. So ROE is latest 8%, here 21%, so that will be a tick. 3 years 18%, more than 8, tick. 5 year average 16%, tick. Profit growth or earning growth 22, 34, 60. So all is more than 12.5. So here they are okay. Sales growth 27, 21, 17, more than 10%. So the filter is fine. We just need to see ROA, that we either can check on stockage, or because this screen, no, because these ratios will give only, limitation of 20 to 23. You can go to edit ratios and can check that. You can go to edit column here, and then you can, from the ratios what Nishit has shown in the video, you just can add ROA 3 year and 5 year, and then you can get everything in the screen. Huh? Hmm? ROA is not coming. So I think that is the thing even we were puzzling, but ROA is not coming. So you just need to go to edit column. You may remove certain ratios and then add ROA recent 3 years and 5 years, but you can get it through stockage as well. So now let us check the trend. This trend. We'll check the. I open the stockage that we have to see in stockage, and Nishit is going to help. So we check regarding the feather and flag for the trend analysis. So same ICICI Bank. First is the pledge, so that will come in the shareholding. 0% pledge, so that is a feather. Then ROE and ROA will come in the fundamental ratios. The first ratio, so ROE, you can see 5.2 and 9.7, 14, 15, 17, it is increasing. So that is good, more than 8. Check ROA, 0.86, now 1.37, 1.5, 1.86. So it is also increasing. And here you will also get a net interest margin, NIM. So in the single return ratio, you will get all three parameters. And if you see NIM 2.9, it is also increasing. The trend is good. And the recent March one, we have seen it's 3.6. Here it's 3.79. So that is also higher than that. So NIM is also increasing. We go to efficiency ratios for NPS. Now, if you see here, you won't see anything because NPA, they will not show on the consolidated one. That is the only thing which we have to see on a standalone parameters, and you will get it here. So gross NPA reducing, see 9.9, 7.3, 6.5, 2.87. That is decreasing. This is the net NPA, that is also decreasing. So it factored all, passed all press parameters on this thing, and even the trend analysis also favoring. Now we just go to the peak analysis. As I said, it is not very cumbersome compared to the drop one. So we just go to profit and loss from financial. This is the profit and loss. What we see, the first one is interest earned. It should be increasing. See how the interest income has been increasing. So that is again a feather. Provisions will come here. So provision also has been decreasing. So that is also good. That is also a feather. Balance sheet. Only three parameters we need to see. One is equity. Equity come in the first one. This is the share capital. It is stable. There is no much increase or decrease. So that is also stable. Deposits will come here. It should be increasing, gradually increasing here. And advances here. That is also increasing. So that is also a feather. Now we have to see promoters. So we'll go to shareholding tab. See, it is a there is no promoter because there has been a professional company which has been managing it. So we need to see the FII and the DII data. See 45 and 47%. It is all stable, all stable. So FII also stable. In public is also not very much. The non-institutes are the public ones. So they are in fact reducing. So that is also a good parameter. Now comes to C. Again we go to the financials, fundamentals, and again ratios. The liquidity ratio is where you will get CASA. And see, CASA is around 49, 45, 46, 48, 45. It is more than 40. So that is a good ratio again. Cost to liability will come again in the efficiency ratio. So here only three we are going to check: return, efficiency, and liquidity. No need for growth and solvency. This is cost to liability. It should be reducing 3.62. As I said, CAR is not available anywhere. We need to go to phenology. We have phenology here. क्या है? Phenology ticker. And if you type here ICICI Bank Limited, you will get CAR here 18.34%. So it is well above 12. So here also it tick. So all green. So ICICI Bank, the recent price has been going up because fundamentally it is good. We are going to have one or two more example because then you will probably more clear about this. So let's see the Dhanalakshmi Bank, whether it will really give Dhan and Lakshmi to us or not. So press screen. Let me remove this. It's a market cap of only 1200 CR. So pledge 0%. So it's okay. ROA anyway will not get it, and this three we will straight away get it from profit and loss here. So here 13, 9, and 4. So 5 year it is not, sorry, it's ROE here 6, 5, and 6. It is not matching any criteria, less than 8%. So we won't do anything here. Profit growth 19, 16, and 37. So this is really very good. And you will sometimes you will be tempted that the profit is very good. The sales growth only once it passed, these two it has not passed. So now we need to check for the trend. So trend we will go to stockage and Dhanalakshmi Bank. So here we don't know about RA yet, but these two parameters it has not passed. So press trend again, we have to go for a pledge in shareholding. Again, it is a publicly managed company, so pledge is 0%, so that is good. Let me remove this. Then for ROE and ROA, we go to fundamental ratios, and the first will give it us. So what is happening on ROE? It was negative in 19, then gradually increase, but again from 1.9 to 10.05, then 5, 4, and 6. So it is a wishy-washy thing. Still, this one is less than 5 years. So probably we'll say it is not a feather but a flag. ROA, see it is less than 1. That means they are not earning well compared to the deposits. Again, little fluctuations. So we'll give it as a flag. Net interest margin is gradually picking up 3.35, but still it is less than 3.6. But still, you just give them a benefit that, okay, we will keep it as an increasing one. NPA will get in liquidity ratios, or not liquidity, efficiencies. See, NPA since last 3 years has been decreasing, 1.16 net, but it is still higher than whatever the value which have been taking 1%. This is less than 1%. Okay, still we give them a doubt of, benefit of doubt. And gross NPA 5.19, 6.30 to 9.23. Now, is this a good marking? Obviously not, because we know only one thing about banking sector, that is NPA, NPA, NPA. So if your NPA is higher than whatever the industry average, let it be, trend has been plus or minus. We should not deviate from that thing. So probably we just need to remove this, and we have to keep it here because it is higher than this, both the things. And now let us check on the peak parameters. So we go to financials. First is profit and loss, interest earned, gradually picking up. So it is a feather. Provisions also decreasing. That is also a feather. We go to balance sheet, equity capital, share capital almost stable. Good. Deposits also increasing. That is also good. And advances. So that is also growing. So that is also good. So this two part is good. Now we go to promoter or shareholding. See the FII trend decreasing 11, 6.1 and 5.93. So that will be the big flag. See the DII stable but decreasing from whatever it was. And see here the retailers, 94% are the retailers with very few FII, very few DII. So this will be a big flag. So even though this is good, this we have to take into consideration. And again, we just need to see CASA on liquidity ratio. CASA is 31.90, where against ICICI it was 42, 45. So it is lesser than the peers. and the cost to liability, that is good, it is decreasing. So CASA is less than this thing, cost to liability is decreasing, and now we just need to see CAR, and you just type it here, Dhanalakshmi. No, Dhanalakshmi Bank. CAR is 12.32. So this is a small bank, lots of retailers don't have good capital adequacy. It is just nearby the range. If something stressful will happen, it will suddenly go down. So I think when you put everything together, then probably you are sure, okay, this is not the bank which is worth investing in this year. Let the fundamentals will improve. So how many time we have now? Done? Okay, so I think mm, this is just an uh, overview is an example, and we just end with the quote from Charlie Munger. I think everyone's favorite, that opportunity comes to the prepared mind. So if we know how to analyze, if we know how we are prepared, probably the opportunity is just next to our door. I think the whole concept of drop and pick two, we have started with to prepare everyone. I think initially many of us will have queries and question why so many posts on WhatsApp and Telegram, but we thought that fundamental analysis per se it's a so difficult subject that it is impossible. Yes, you just start on the presentation and you will learn it. So you should have some background. You should have certain kind of a foundation on which if we deliver talk, probably they are going to help you out. So with this, I end this presentation on banking sector.